Welcome back. This is Chart Overload. We are Sollinda Capital Management. I'm Ryan Mumy, the CEO. With me, our Chief Investment Officer, Mr. Justin Greenhill. Chart Overload, we go through a bunch of interesting charts that, we feel like maybe the mainstream media isn't necessarily talking about and, what we think about them. But Justin, let's go ahead and get started with the big picture. This first one looks at the new tariff wall, if you will, is the Trump administration's tariff policy basically got struck down by the Supreme Court, and they're ramping them back up here.
Yeah, so this hasn't got as much headline as it did a year or so ago. Again, probably because the anticipation is that it's going to get blocked or reversed. And, one could be cynical and say that it's just political at this point. But as you can see here, these are, for the time being, considered to be permanent tariffs, albeit with a caveat for a deal. And they are justifying it based on, if I'm not mistaken, child labor or forced labor, I believe is the term. So I think we will show that this is once again, in the background, but we'll quickly move on because again, I think the market will likely ignore it.
Next chart looks at the U.S. logistics market and the cost of transport, and as we see here, they are going up.
Yeah, so this is just kind of, we've been talking about inflation and this resurgence of inflation. Wanted to show here about how we're starting to see indicators, this chart, and we'll show another one in a subsequent section, that it is starting to make its way through to the actual economy, seen here in logistics.
Which was, it has been the reading of every inflation measure over the last month. Is it's not isolated to just energy costs; it's starting to bleed out into other areas of the economy. Next chart looks at Google shares. Really interesting because we've talked a lot about how these big tech companies have been, buying back their shares, which this shows with Google. And then just recently, we see a little mean reversion, bounce higher.
Yeah, this has been the big theme that we've kind of been talking about and illustrating, is that the massive CapEx happening by these big firms has to be funded somehow. So it's either going to be funded through the debt market, or in the case of Google, or it's going to be funded through equity issuance. So one of the big themes that is probably not talked about that much yet, but could become increasingly so, is just the fact that the US stock market is seeing a big increase in supply of shares outstanding, be it the massive IPOs, SpaceX, and a couple others that are likely to come, but also these companies that have been taking big profits and buying back their shares for many years are now doing the opposite.
Yeah, which is a measure of liquidity, right? If there's fixed amount of liquidity and it's not increasing, and there's more shares to purchase, then obviously that can cause some price swings. So that'll be something to watch. Next chart looks at CapEx relative to the revenue, and again, just a really interesting way of looking at some financial metrics of companies.
Yeah, and this goes back, quite some time, and just basically shows that in general, companies that are spending lots of CapEx relative to their revenue decline over time relative to companies which are doing the opposite. So if one were to look at, Google and Microsoft and these big tech companies over the past several years, they would have been the beneficiaries of this relative chart because they were the companies that were not having to spend on CapEx due to the network effect and the unique nature, digital nature of their business. Software companies being an extreme example,
Right.
versus we're seeing a lot of these companies start to shift back to high CapEx. So, it's too early to say, but there could eventually start to be quite a bit of dispersion in the market between these types of dynamics that really hasn't been in play for some time, at least not in the mega caps.
No, companies that release at earnings their CapEx expectations, the bigger they are, the more they've been rewarded, and that marginally has gotten worse. Right, some companies have responded negatively to big future spending plans. So again, I thought this was a really interesting way of looking at the, again, financial data and the history of a couple different.
One more thing to just note about this chart is, high CapEx spending relative to revenue underperforms the opposite. But naturally, if CapEx increases revenue, then that becomes a positive thing. So when we talk about dispersion, it is very possible that all of these companies that are spending such massive on CapEx and are having to issue new shares, some of them may reap the reward for that on the other side and others won't, I think is key.
Yeah, to be determined. Next chart looks at the memory stocks and the gains that they've had recently, which we've talked about for a couple of chart overloads. Just it's been ridiculous the return some of these companies have had, and this just visualizes that.
Yeah, it's a crazy chart. Last year and especially the year before that, it was really all about kind of the specialty chip providers or equipment providers, in AI. And before that, it was about the companies that we mentioned that had kind of like network effect and had all the data. Most recently, it's been the companies that have been traditionally the most cyclical that have really outperformed. And it's just a shortage and a bottleneck of memory chips, which has impacted not only names listed in the US, but we've discussed and we will in the subsequent session. It's had a lot to do with what's happened in Asian markets, in particular Korea as well.
Next chart. This is fresh data, right? This is we're recording on June the 5th, Friday the 5th, and this just came out that the U.S. payrolls just surged in the freshest data point. Which sends a lot of signals throughout the rest of the asset investment world.
Yeah, I mean, the big signal is this, when combined with inflation, makes it look like not only is the Fed not going to be able to cut, but now as of today, they are pricing a hike. So you can also see on this chart, the orange lines, that the job market was pretty weak throughout most of last year. And despite all the new uncertainty this year across, several different fronts, it's actually started to strengthen.
Yeah, I mean, fourth quarter last year, we were talking about the unemployment rate hitting what 4.6, 4. Yeah, so it's really improved here recently, and it's been as we'll talk about later, it's caused quite the reversal in the Fed funds futures. Next section, let's look at domestic stocks. First chart, again, we've showed different variations of this. It shows the percentage of households' financial assets that are held in stocks, and that number keeps growing.
It keeps growing. So the so-called wealth effect, which is the result of this when stocks are actually going higher, which just simply means that relative to the total assets that households own, they own more stocks than ever. And we hear about that. We've seen policy respond to that. So it's like our joke, Ryan. We say society in America is all in.
Yeah, all in. Well, it keeps going up, and that's the thing. It can keep going up, but as we see, eventually it reaches a point where it goes down a lot, and that's the thing is who knows when that'll be. That's why we're looking at all this different data and all our different data models. Is maybe they'll start flashing a little red when that looks to be the case. The takeaway for clients here would be to rebalance your portfolio. I mean, harvest some gains and put it into the things that haven't performed as well. But again, history tells us that oftentimes clients don't do that. Next chart looks a little bit at the what we talked about, the liquidity function, the supply aspect of shares in the market. This looks at new IPOs coming on in 2026, and that's a big number.
Yeah, that's a massive number. So, I mean, to put this into perspective, there's going to be $225 billion of new stock into the market this year based on just these IPOs. So obviously that doesn't include the fact that some of these bigger already traded companies, like we mentioned, Google, are also issuing new shares. So while that in and of itself is not a negative, it just simply means that, the same amount of money that we have discussed that's kind of coming into the market consistently through whether it be 401ks or IRAs, et cetera, those now have to buy even more stock continue to move it higher. So there's a supply demand in the stock market equilibrium that is potentially really going to change as we get into the end of this year and into next year.
Yeah, and we don't feel like most people are aware of this or nobody's talking about it. And it's not going to be a headline like Iran or earnings, but it could turn into this gentle headwind against the market, just gradually moving higher, right? Like we usually see over time. So it's just something to be aware of. I don't know that there's any action on it today. There could be, but be aware of it. Next chart looks at, everybody talks about bubbles. This just looks at the history of stock market concentration, past time frames going back into the 1800s with railroads. But this looks at the concentration in the Big Ten, Magnificent Seven plus Broadcom, AMD, and Micron. And, we're getting in the range of where there's been concentrated security ownership relating to past times.
Yeah. So although this is notable for the US market, it's important to note that, generally speaking, on a relative basis, the US stock market has been much more diverse and dynamic. So the biggest companies haven't had this much concentration. You look at other markets, like we'll show one here later on, I think. But basically, it's the opposite. So either the US is changing in terms of we are now going to have a much more concentrated stock market with a few big companies basically dominating the overall economy and, the market, or this is something that happens in a mature bull market based on whatever theme that it is. So we'll see. But this is, I mean, if you wanted to be bearish, this is a pretty compelling
Yeah,
chart right here.
this is
This
the
is the
one.
headline. Yeah,
Yep.
this is the one.
And then moving on to chart looking at small caps. This just looks at the smallest companies in the Russell 2000, and it looks at the percentage of those companies that are not making any money.
Which is high, and you see this really started going up post-global financial crisis when interest rates were so low for that period of time. And this is always, you talk about a headwind to just stocks in general, and the mega caps might soon be excess stock being, listed into the market. What has remained a headwind for small caps every time they've rallied now for a number of years, excuse me, is just because of the fact that so many of them are unprofitable. So you end up having, short-lived small cap outperformance when it looks like rates are going to come down or there's some sort of new impulse into the economy. But once things normalize, this becomes really a barrier for them to go higher. And also, we've talked about this, but a lot of these companies are always issuing more stock. So while that's been rare for the mega caps, it's very common for smaller companies to issue
And
new shares.
they're much more reliant on debt. So interest rates are also a major input to their financial performance. Moving on to the next section, let's look at rates. The first chart looks at the 10-year U.S. Treasury yield, and we've started ticking higher here recently.
If you look at the daily changes, it obviously shows there's quite a bit of volatility in 10-year rates, but ultimately they're up a little bit year to date, but not that much. And perhaps most interestingly, they are now firmly back below what was the high hit roughly a month ago. So there's not really a lot happening in the interest rate market. We had discussed, I think, in our last video about how the interest rate market was sort of pricing in the oil shock, but the stock market wasn't. Now, at least as of this week, we're kind of going back to the other side. The bond market is calm and the stock market tends to be. So I think this all goes back to that correlation. The market in general is trying to figure out what level of interest rates it can tolerate. And although that is clearly higher than it was, some years ago, it's yet to be consensus where that is. Is it 5 on the long bond or not?
Next chart looks at options on the Treasury market, and we see things again moving lower.
Well, this is not as intuitive unless you kind of look deeply at it. But basically, think of these lines as, well, first off, this is 10-year, 2-year, 5-year, and the so called long bond. And when these lines are further down on the chart, that simply means that market participants are buying protection, meaning they think rates are going to go up. So naturally, as we've had this, inflation shock, which started as an oil shock, people are wanting to protect for higher rates. And to the past comment about how rates have really kind of quit moving and are off the highs, this could just show that participants perhaps got overhedged for higher rates initially after the oil spike.
Similar to what we saw in the stock market following the
Okay.
Iranian situation, right? Which,
Yeah.
just it didn't necessarily cause it, but it gave credence to the market moving higher as people worked off their downside hedges. Similar thing
And
could
one
play
thing,
out here in rates.
right, and one thing we've kind of talked about this quite a bit is just the size of the derivative markets. In this case, the option markets have become so large, and so many different types of participants are now using options, futures, etc., to hedge, that you have these scenarios where, the market may not be that move, it may have not have moved that much, but people are actually very hedged. And then, as we saw with stocks earlier in the year, and potentially to a lesser extent with bonds, a little bit of that worry goes away. They close out those hedges, and that actually becomes a pretty strong impulse for, price to go the other way.
Next chart looks at levered loans, one aspect of the bond market. And despite all the fears, the prices have continued to go up.
People would, at large, it seems, prefer to buy levered loans than they would U.S. Treasuries, which is an interesting concept. But I think it really just goes to show that there has been so much negative narrative around the deficit and the insustainability or unsustainability of just U.S. fiscal policy, not to mention, global central bank diversification and so on, that, to your point earlier about how in the old days, when valuations reached a certain point or people reached a certain age, the obvious thing to do would be, let's just buy a bunch more bonds, treasuries, than stocks. But now it seems that for a couple different reasons, really on both the equity side and the bond side, that allocation has tilted much towards stocks, and there seems to be a reluctance by, market participants to put that back into treasuries.
And even when
And
they're buying on the fixed income portion, they're buying more what would be considered risky fixed income.
this being an example of that,
Yeah,
yes.
absolutely. Next chart. Again, this is fresh data, looks at Fed policy path projections. Again, coming off the employment report that was very robust. This shows what the market's expectations are for the path of the Fed's rate cuts or hikes. And yellow line is as of today. Green line is as of February. In February, they were anticipating some additional cuts by the Federal Reserve. And now they're fully pricing in some hikes.
Yeah, it's a big swing. So it went from pricing in, up to 75 basis points of cuts by the Fed into the end of the year, to now a 25 basis point hike, which, to our prior comments, thus far, markets, both bonds and stocks, have absorbed that change pretty notably. And it kind of makes you think that, let's assume things do start to normalize and those expectations go back the other way on the margin, that then could be quite a bit of liquidity back to the market also. So it's, very uncertain in terms of policy. And then, you and I were talking earlier, Ryan, about you bring in the new Fed chair, and there's also uncertainty around, how he wants to be seen in this environment. It would have been very different had he come into an environment that didn't have an exogenous shock like the oil, versus now he's going to have to, you know, respond to that, but at the same time, respect his mandate that he is Trump's guy. And we know what Trump likes: low interest rates.
Yes. Moving on to the tour, where we look at some charts from outside of the United States. First chart looks at delivery times and prices relating to suppliers, and what we see here is prices are going higher and delivery times are going lower.
Similar to our logistic chart in the first section, this is just an example of how inflation is now being passed through to various different countries that do quite a bit of exports. And not only that, but similar to COVID, albeit less so, there is some disruption in just the ability to actually move goods around, which is what this represents. So it's kind of shown up everywhere, and we'll see if this continues to manifest. But there is definitely a pretty large headwind emerging, not just to the real economy based on this, but to the financial economy based on the fact that interest rate expectations are now higher because of these things.
Next chart looks at Korea versus Japan. We've talked about the Korean stock market being a reflection of the AI story in the U.S. because of some of the manufacturers that are headquartered there, and what this shows is pretty remarkable growth relative to a major developed economy in Japan.
Yeah, so if you look at the black line is net income by Korean firms. That's basically more than doubled in a couple years, which shows how much money they're making from these memory chips and things like that within the semiconductor ecosystem. Just the demand has been so high relative to the supply, and that's the things that they make. So it's going to be really interesting over the next couple years to actually determine just how cyclical these industries are, because historically they've had been, higher demand, higher prices, more supply. And
They ramp up supply and drive down the prices, right?
and if that were to go the other way, one could say that, this income by Korean firms is, not sustainable. But
Yeah, in the next chart, right, it goes right into it. It compares it a little more granularly, looking at Korean chip giants' net income relative to Japanese firms, and I love that they threw the 7 major auto manufacturers on there too, to just give you some relative to the numbers that Korean firms are pumping out here.
in particular, those two, right? I mean, they've just, I guess that's a more detailed version of the chart right above, but it's really incredible how much there's just been a re-rating in, not just the stock prices, because if the stock price went up and this chart didn't exist, it would be less justified, but the revenues have gone up, right? The profitability to the firms have gone up. So the question then is, can that sustain?
TBD. Next chart looks at Indonesia. I think that's a fresh entry to our chart overload series. Looks at the Indonesian stock market relative to the rest of the all world country index, and we see some pretty sizable underperformance here.
I have been to Jakarta one time, so that does make me an expert on the topic. And I will say that this has kind of gone under the headlines, is that it's obviously far away and it's not a major financial market. But what's basically happened is Indonesia, big commodity exporter, the government has come in and just taken massive control over the private firms that deal in the economy, and there's just been a tremendous regulatory uncertainty, and everything is being shaken up at this point in terms of what to expect from just the ability for companies to operate and make profits. So we put this in the chart this week just to show that while certain emerging markets, we mentioned some of the ones in Asia in particular, are kind of higher value chain. A market like Indonesia is very much not, and it's also very much kind of classic emerging market political risk. In that one minute things are business as usual, and then now it's completely changed. So as you can see, a
Yeah,
lot of money has
they
poured.
yeah, they basically nationalized part of some of their major, corporations, and that's obviously impacted what investors are willing to pay for the shares. Moving on to the next chart, looks at Brazil. Brazil been a recipient of quite a bit of inbound cash flow for better part of all of 2026 and part of the fourth quarter of 2025, and that's moved in the opposite direction here recently.
Yeah, this is just kind of another example of the market, various markets repricing the expectations for inflation and the expectations for higher interest rates. Coming into this year, Brazil was very much believed to be a huge beneficiary of a global rate cut cycle, because the rates there, as we've talked about, are so high. Now that looks less likely to be the case, and at the same time, you have a election in which fiscal spending has become a big topic or a big potential risk. So we were actually just meeting about this earlier, but one of the interesting things now is it's very much back to what is the central bank going to say or do. So similar to in the U.S., are they going to feel the need to signal or respond hawkish to this pickup in inflation, or they're going to try to ignore it? And in the case of Brazil, it could really go either way. And depending on which way that goes, could really be a big driver of the market in the near term.
We'll find out in a week and a half, right, when their central bank meets. Moving on to the next section, let's close it out with commodities. First chart, I don't think will surprise anyone since the Iran war. Stockpiles of various energy goods have dropped, and that's obviously what this chart reflects.
We were talking about earlier too before this call that what's interesting is oil is not only still off of its highs, but is actually moving lower today, which just from a pure basic price analysis standpoint, it's looks like it's lost its impulse upward, at least relative to what it had initially when the conflict in Iran started out here, what, a couple months ago. And a lot of that has to do with the fact that, although US stockpiles are low, you move to the next chart, China has been importing much less oil of late. So it seems that China got to do a lot of their oil stockpiling at lower prices. And thus, that lack of demand has really helped buffer this impetus higher in prices. And another thing I think it speaks to is the degree to which China has shifted to electric cars domestically is pretty substantial. Not only have they supplied those cars all over the world, in particular outside of the US, but they are now very much electrified, which is, not an insignificant decrease in oil demand.
No.
So we'll see. I think if one had to kind of determine what is going to be the kind of the linchpin of does this oil shock become more significant or not, is obviously, what direction oil prices go. But if in fact China and some of these other countries need to start scrambling to buy oil again with, current physical stockpiles being as low as they are. So far, that's not been the case.
Last chart looks at copper relative to the U.S. technology stocks, and the correlation has went up of late to what have been historic highs.
Which would make sense, right? Copper's kind of or not kind of, it is a huge component into all sorts of things electrical, whether it be, military equipment, electric batteries, and so on. So naturally, you've seen it kind of pick up a correlation with tech, which is also very much moving on sort of the AI spend, AI CapEx type dynamic. And what's interesting about copper too is it's a market where the supply demand is really not quite as easily forecast as it might would be in oil, or at least it's not as big of a market. So it can, in fact, get caught very offsides and move in both directions. And there's a lot of speculation in that market. So the really only takeaway from this is that copper still exhibits positive cyclicality to the global economy like it always has. It's just that cyclicality used to come from demand for infrastructure versus now it's coming for more specifically demand for, electric infrastructure.
And back to our previous conversation is, does the CapEx cycle continue? Do companies does their earnings pick up? Because if not, then now the price of copper is highly correlated to that continuing or not. And again, that's why we look at this: is there a new relationship forming, or or will things, should they over time go back to the historical relationship? So, but that's all we got for this chart overload. We appreciate you spending some time with us. If you have any questions, you want to dig any deeper, feel free to reach out to us at info@sollinda.com, info@solinda.com. But we'll be back again in a couple weeks. Thanks.